in Kyushu experiencing outflows. We need to foster attractive businesses and community in other areas as well. And economic disparity and poverty are also getting more serious. And Japan has a high relative poverty rate, which is in 2022, the second highest among G7 countries. One reason is inflation, and that rate rose to 48% for single-parent households. And other issue, as you know, Japan is often hit by typhoons, heavy snowfalls, floods, landslides, and earthquakes, tsunamis, or actions. According to Cabinet Office, during 1984 to 2013, natural disasters in Japan caused about 400 billion damages, which is about 17% of those in the world. And as was seen after Great East earthquake and Kumamoto earthquake, it took a long time for the local economy and social environment to rebound. On the other hand, Japan's sustainable investments are expanding very fast, and it now accounts for 62% of the total assets under management. And I'm working as a board member of GPIF, the large national pension funds in Japan. And GPIF is very committed to the ESG investment. And GPIF started investment in equity, but currently expanding to fixed income, project finance, and real estate. So I think we could really leverage this trend, and sustainable finance, such as green and social bonds, will probably be a good tool to address sustainable challenges in the regions. For instance, in the medical care area, some Japanese local government used social impact bonds and reduced the cost of finance. And another thing is some finance for natural disaster. One is the social bonds providing assistance to victims of natural disasters. And the second is the catastrophe bonds issued by insurance companies and other financial institutions. However, unfortunately, the issue of such bonds are still quite limited in Japan. And constraints include unclear criteria, little knowledge of issuers or governments and financial institutions, and the time and cost of certificates. And then I'd like to introduce some initiatives by local governments or financial institutions. You know the name Niseko in Hokkaido. It's an area's famous ski resort. Hokkaido, without tourism resources, have more. Inoha's town has experienced a decline of population, and it declined by 95% in the past 50 years. However, the town had some alliance with large corporates, and they succeeded to foster new industries such as forestry or biomass power generations using new technologies. And they also improved some disasters issues, by centralization of the towns. And then this city is known as a SDGs future city, and because they really focus on decarbonizations and biodiversity, so attracted a lot of younger generations. And new immigrants led to reduction of the population of elderly people from 52% to 28%. Let me also introduce one other example. It's Hokuto Bank, regional bank, and they fostered new energy companies, startup companies. And Akita Prefecture boasts of the largest wind power generation. And however, that power sources are kind of occupied by Tokyo or foreign capital markets. And so they had quite a limited contribution to the Akita's GDP. However, Hokuto Bank emphasized the development of local power generation project with the slogan that local production for local consumptions. And they set up the wind power generation businesses, and it is Wenti Japan. And they also had tie up with the local builders and manufacturing companies. And as you know, wind power generations, they need a lot of parts industries. So they contributed to the employment of such parts companies in Akita Prefecture. And in 2013, Wenti Japan also began supporting a woody biomass power generation project by young entrepreneurs. And this project used unused wood in the prefecture, which had previously been discarded. And in Japan, you know, the more than 70% covered by forests, but Japan's industries have not used properly. So this project is also expanded to lead to forest improvement and forestry regeneration. And it's estimated to have an economic impact of 50 billion yen and employment of 1,000 people. Okay, and the last one is ESG scoring created by Fukuoka Bank in Kyushu. And as you know, among the SME sectors, the concept of ESG has not been not so well known. And according to the survey of Chamber of Commerce, about 50% of SMEs do not have any decarbonization plans, and more than 20% don't know what to do. However, they are under the pressure from their some large corporations, because large corporations, they need more decarbonization, some progress in the supply chains. So the Fukuoka Bank made some ESG scoring and had a lecture on SME and the progress of decarbonization. They gave a certificate, some progress to SMEs, and some discounted their interest rates. And as the bank launched this ESG certificate, new business tie-ups has been created among SMEs seeking to solve these environmental issues. And as a next step, bank will create a data platform because it is not very efficient that each region has its own database. So they like to have more standardized database and sell this scoring system to other regional banks. And also they like to start carbon credit transactions among SMEs using blockchain for very reasonable prices. So I have introduced some initiatives in Japan how to connect ESG investment and revitalization of the regional economy. And I think these are some initiative is not prevailing in the whole Japan because there is a lack of public knowledge and also experts on the ESG investment. And so I think local governments and private companies, industry associations, banks, and university need to work together to address these issues. And I think regional banks can play more central roles in these ecosystems. So I hope that these seminars and your research will be also a very good contributor to the development of ESG investment and revitalization of the region. That's all my presentations. Thank you very much for paying attention.
Thank you so much, Dr. Nemoto. So, do you have any question? So, online. Okay. So, please have mic. Oh.
Your interesting presentation and sharing with us the latest progress of ESG. I'm glad to see that this topic is going to be more important in Japan. Regarding SMEs that you have mentioned, so is there any plan at major Japanese banks, for example, 3 mega banks, to look at the environmental performance, or not only environment, but also other aspects of ESG performance of SMEs? Because nowadays, bankers are just looking at the profitability and the balance sheet or financial statements of SMEs, and not paying attention to whether this SME is using renewable energy, or this SME has ladies in their board, or what kind of fields or what kind of projects they are investing. Is there any plan for these things, this approach? Thank you.
Thank you very much for very good, great questions. I think major banks are currently trying to make more progress in terms of scoring and also the how to kind of assess the ESG progress of major companies and SMEs. I mean, they try to incorporate the ESG risk in their internal rating. I mean, and based on that, they decide the pricing of the loans or make other things. And also they like to do a more consulting works for them. I mean, it is great opportunity for banks. I mean, to kind of get some fees and also support those companies. However, that plan is still at progress, and especially for SME sectors, the data is quite challenges. Did I answer questions? Hello.
So, are you ready?
Dr. John, did you hear us? Yes, please start.
Okay, thank you very much for this kind of opportunity. So today I will present our research on the ESG regarding the nature investment in Indonesia case study. So the first slide we are discussing about the how to become net zero according to the latest IPCC report. So the agriculture sector and forestry and land use sector can contribute 23% for the greenhouse gas emission to achieve the net zero by 2015. And further, beyond net zero of greenhouse gas emission, there is another notion coming, which is called nature positive. Because net zero is meaning only the greenhouse gas emission, but how about the biodiversity loss? So the nature positive here, we get additional benefit. In addition to net zero, we also get the positive of the nature, as so by the right one picture, rebound of the biodiversity loss by 2,100 in case we invest in the nature ecosystem. Indonesia, for the study case, we put Indonesia because Indonesia is one of the largest forest area and a lot of biodiversity. So the study case here, what is the current situation for the nature investment? Several areas, mostly in the Sumatra Island and then Kalimantan Island from Indonesia, and this is the carbon market here is very huge because it's around 50 million ton CO2 credit carbon market. But when we are talking about the global scale, the voluntary carbon market now is very hot topic. Is about two issues. One is about the nature-based solution from forest area, and the second one is from renewable energy. So if we see the time frame from 2010, 35 million US dollar, and now become the carbon market around 290 million US dollar. And 80% of this carbon market is coming from the NBS, nature-based solution, whether this is avoidance or whether this is removals. So, and the rest is from the renewable energy like solar panel or biomass. Before the former presentation is the biomass power plant and so on. Further, because the climate issue is become very serious, the carbon emission is not only avoidance. We need also to remove the CO2 from the atmosphere, not only by avoiding deforestation, but beyond that, we need also to capture all the CO2 in the atmosphere. So many activity is related with the nature-based solution. For example, afforestation, reforestation, improved forest management, soil carbon sequestration, biochar, bioenergy with carbon capture, and then the peatland and coastal wetland like mangrove should be restored, and the blue carbon such as the seaweed also should be utilized to reduce to capture the CO2. This is all the NBS, but the carbon dioxide removal also can come from technology perspective like direct capture carbon storage, enhanced weathering, and ocean alkalinity. The study case is the preliminary calculation. For in case we do the peatland restoration, for example, some area, the peatland will be if we don't maintain the peatland will be drained, and the emission is keep leaching off the atmosphere. However, if we do rewetting and manage the peatland very well, we can get a very huge discrepancy. The gray curve here is so the restoration. So the emission totally different, and the expected emission reduction in the blue line is so quite significant ton of CO2 we can save. So the study case here is around 2,000 hectare area, and this is within 4 years. The expected emission could be 236 1,160 ton CO2. However, we will have the risk. The risk is coming from, because the peatland is nature ecosystem. There is a risk we call here as the non-permanence of deduction. The risk is around 15% because we cannot expect all the peatland will be capture the CO2. Sometimes the quality of the forest in the peat area is not as what we estimate. So the risk we're taking 50%. And also there's another risk adjustment which is called possibility of the fire. Possibility of fire here, we put average weight 35% of the risk. In the conclusion, the latest IPCC report is mentioned to achieve net zero greenhouse gas emission in 2050, 23% should be coming from the agriculture, forest, and land use sector, and the rest from the energy related. The nature positive by utilize the nature-based carbon dioxide removals have been promoted beyond net zero, which is provide incentive in terms of carbon market and also biodiversity gain. The nature-based solution investment is mostly still in avoided deforestation for this moment, but in the near future, it will be shifting into the nature positive by afforestation, wetland rehabilitation, biochar, and soil carbon sequestration. The voluntary carbon market has been grown up from $35 million in 2009, become 366, and later drop into $299 million in 2020. Nevertheless, this is already increpancy 800% within 14 years. The natural-based solution, avoidance emission, and renewable are still the two highest contributors for the voluntary carbon market. However, in the near future, the nature-based solution will be relied on the removal because the avoidance emission is not enough to solve the climate change issue. Last but not least, the financial benefit on the nature positive, for example, in this study case, the peatland rehabilitation, should be taken into account. There is a factor of non-permanence factor, and also should be taken into account the fire risk, because this is natural ecosystem. Sometimes the weather, the climate extreme could make not as what we expected this carbon farming. So the factor could be 15% and 30% respectively. Hence, the net actual greenhouse gas emission we can expect from the net is 55% because 45% gone for the risk factor, whether this is fire, whether this is the grow not as expected. And the study case, if the 2,000 hectare we did the peatland rehabilitation, we can expect the case monetary around 952,000 euro, is around 1 million euro. In this moment, we put the carbon price very modest, 7.5, which is the current existing, which is purchased by company like Unilever or L'Oreal. At the capital cost and operating cost 20% and 15%, the net profit could be estimated 65% from the total case monetary. So this is roughly around 619,121 euro over 4 years. If we spread this amount into 2,000 hectares and then into per year, so the carbon farming by doing the peatland rehabilitation will give cash benefit 7,739 euro per year per hectare. Thank you very much for this kind of opportunity.
So thank you for good presentation, Dr. Johnny. So do you have any question? Okay, so please wait.
So yeah, thank you for your presentation. I'm actually a researcher at the Kitakyushu City. Soon I'll be involved in a company called Shabon Damasol, which is located in Kitakyushu. they developed the fire extinguishing agent, which is going to be very effective in Kalimantan for the peatland fire. So we will test how effective this agent will be. So I'm very interested in this nature positive thinking in Indonesia. So you mentioned about the risk, the fire risk of peatland. I think the peatland can be a big absorption for the carbon sink. So it's very positive. But on the other hand, there's a huge risk. Once there's a fire, the peatland can emit 20, 30 times more carbons into the atmosphere. So in your system or thinking, how do you manage this fire risk? Is there any effort by ESG or private sector to mitigate or reduce such fire risk, especially in the peatland context in Indonesia?
Yeah, thank you very much. This is very important question, and I heard about this issue very a lot already. So, and also from here, there are some of my colleagues actually working on this area, also like Kitawati, the professor in Bogor. So, in my opinion, because the government of Indonesia very concerned about to achieve the NDC. So actually, the emission from the country is mostly coming from the peatland fire. That's why this is taken care from the government, and there are many strict regulations. You cannot burn the peatland, especially during the seasonality, the summertime. So the problem in Indonesia is the summer is sometimes extreme weather, and this is the peatland very easily get burned. But with for the what I understand, all the company, the plantation area, which is has on the border with the forest, they have very strict the water management system, because the peatland, the key of the peatland, you have to maintain the water table 20 centimeter above the ground. So this is to make sure the peatland is always moist even in the summer. So during the rain season, all the company must have the water bank system, and during the summer, the water bank will be supplied to keep moist the peatland. The key always keep moist the peatland. So, but of course, nevertheless, Indonesia is very big, 200 million hectares, and the government cannot control everything. So sometimes the fire still occur, but we expect how many hotspots reduce because the water management system in the pit area. So that's why the fire still happen. There is no zero fire basically every year in the summertime. But with the strict monitoring and prevention, we expect this is not so big. That's why this technology, the fire extinguisher is very useful, but please keep in mind, because the area is very big, this fire extinguisher first must be can cover very big area, and also can make very efficient costs, because the budget from the forestry is I afraid not as much as from the manufacturing industry. So this is just the key to make sure the pit fire extinguisher technology can be very well. But Indonesia government also try to use the artificial rain sometime in the area, which is like the Sumatra area, which is very frequent for the forest fire, and Kalimantan also, because the pit is very deep, 4 meters until 10 meters below the ground. So very hard to, once it's already burned, very hard to kill the fire. That's the problem. I hope this is answer your question. Please contact me if you have any further comments. Thank you.
Okay. So thank you for answering, Dr. Jolie. So do you have another question? So if online audience have a question, please. So, or please write a question in chat box.
I already put my email, so please contact me by email.
Oh, thank you.
Because we have very
Dr.
strict
Jolie.
time.
So if you
thank you.
If you have any question, so please send Dr. Jolie email address. Okay. Okay. Thank you for interesting presentation. So next presenter is Shiti Divaya. So from Center for Economic and Social Studies in India. So this presentation title is Climate Risk and Sustainable Investing in Asia. So please our presentation, Dr. Dija. Pronunciation correct? Probably. Please.
Yeah. Hope my slides are visible and I'm also visible here. Yeah. Hello. Hello. Am I audible? Yeah. Hello.
Yes, yes, we can hear you.
Yeah, thank you. So the presentation today is on climate risk and sustainable investing. Yeah, sustainable investment in Asia. So here, this is the scheme of my PPT is, yeah. The background and introduction, review of literature, objectives of the study, empirical model, data, methodology, empirical findings, and conclusion is the outline of presentation. So the study is basically, we are looking into the climate risk and sustainable investment in Asia, mainly the climatic, ESG movements with the market segments, how well it is connecting, and the background of climatic risk we are trying to analyze, because there is not much studies that is connecting the climatic risk and ESG. And now coming to the background, Asia, as we know in the previous presentation, I'm not going much deeper into that because there's a lot of presentations were saying about the climatic risk and the climatic change and extreme heat, humidity, precipitation patterns, temperature variations in globally, especially in Asia. And Asia is in the front line of this climatic change. So as we know, the CO2 emissions if you compare 2010 to 2020-21, it is increasing for most of the, when it is above the world average for most of the East Asian economies, East Asian countries as it is here. And if you go to the climate-driven risk index of latest 2020-22, which also shows most of the East Asian economies are above 5, so that shows the highly it is going to be climatic risk driven, and so keeping and the projections as per the recent study of U22 et al 2022. There's also projections for up to 2080, and it shows that there's a huge increase in going to be the temperature change. So based on all this background, so we have decided to link the climatic risk with the ESG investment. So in recent time, if you say the sustainable investment gaining much attention with the investors community, because it is because of the environmental and social governance factors. So there is also some literature, recent literature on climate finance documents that connect investors care about the climatic risk and risk exposure and how does it impact their investments have been coming up recently, very recently. So similarly, literature also highlights the importance of climatic risk in running the risk factor. So this is more of a climate finance, or we can say about in finance, how it is the company is managing, how it is impacting a company, a firm. So there may not be a firm level analysis, but overall a macro, as a macroeconomist, I'm trying to bring out the issue here. So mainly what we have says, it is also argued green labeled investments, like which can be like hedging strategies or portfolio diversification strategies, they are mainly used in that form. So there is, but however, there is still no clear understanding on how climate uncertainty affects the ESG based investment as compared to the conventional stock investment. So in this paper, we examine how climate risk affects the ESG assets as compared to the conventional assets in East Asia and Southeast Asia as per the conference theme. So the review of literature is huge. There are some literature, connected literature, but I want to trust on two major risk channels explained in the review of literature. That is, the first channel is physical risk. That earlier studies, some of them explained here in the previous studies. And there is also another channel, transition, which is climatic risk through policies. So physical risk in the sense of floods and any disasters. So how does it is going to affect the ESG investment? How it is going to connect to a stock market investment? So that is the main crux of this. Because most of the studies, some of the studies say high ESG rating is less vulnerable to risk. So these are the reasons for going to, the reasons have been listed here. And so based on this, the objective of study, objective studies that you examine the co-movements between ESG assets and conventional stock market returns, to explore the role of climatic risk in determining the ESG assets versus conventional asset market in East Asian context, to examine whether ESG investment can be. So first we look into the co-movements of ESG. This for the co-movements analysis, that is, if there is ESG assets and conventional stock, whether they are going in the same pattern. Or whether their movement is, what is the movement, direction of movement, so, or a relationship between them. So that we are, since it is going to be very high frequency data, it will be quite difficult to do with a normal econometric techniques or a simple statistical tool. So we have to go, we used the advanced wavelet coherence analysis of mathematical modeling to understand the movements. And the movement, I'll show you the result and then go to the next. So the result shows that there is a movement, because each country, we have analyzed for nearly 13 to 15 to 20 countries, I guess, but we cannot show everything because of the time and space limit. And so I'm just showing you, that for some countries like Japan and China, you can see there's a lot of coherence. There's a relationship is almost same and is going in a positive direction. But whereas some of the countries like Philippines, that is, the coherence is very less. The relationship is very less. So we can say that there is a positive relationship between, there is a relationship among ESG investments and stock index. So that's why we thought of going to the second analysis. What are the factors that determine the climate, whether climate risk is an important factor here in determining the ESG and the stock indices. So that we had to go for an analysis of a panel regression, because we took data of monthly data, 2015 January to October 2022, and 11 East Asian economies we have taken because of the data. See, we are ready to take more data because we are also trying to explore it as far as our knowledge. MCI ESG index we have used, and so these are the fully available data sets that we have used. And another thing that we have, yes. So the model which we use. Yes, so the model which we use here is the panel regression model, which says ESG is a function of output. We divide it into conventional stock, and we also divide into ESG stock. So ESG is, it's more of environment related. So it is, we have put that's a dependent variable, and output, rate of interest, which is measured as short-term interest rate, and output measured as index of industrial production for each country, and climate uncertainty, which we created an index, a composite measure of nearly 4 groups: geophysical, meteorological, hydrological, and biological, and we assign 1 to each group if disaster occurred in a specific month. And that's how we created that index, and the dummy COVID. And similarly for stock return, more of the same thing we have done. And the analysis says that ESG growth rate of the country equity index and stock return is a country's stock indices. Climatic risk is we calculated, And so the result shows that this is a cumulative, just to show you the representation of the trend of the climatic uncertainty index for these countries. This is a cumulative one. The result shows this for each and every country. Maybe it is the country names will be little not much visible. And ESG asset return. And the results says that, as expected, first, we determine the relationship between the determinants of ESG assets to the other. So what we find is that it is climate uncertainty has a positive side to that. This I'll come to that later. And rate of interest negatively affects the ESG assets. Whereas inverse relationship, and whereas output industrial production, if it increases, it positively affects the ESG assets, ESG investments. And similarly, stock returns, if it increases, definitely it's going to have a good impact on the ESG asset. And climate uncertainty also positively affects. And similarly, if you compare that with the conventional stock market, what we see is a negative relationship with the climate uncertainty. So climate has a negative uncertainty, and the remaining are the same. So the final conclusion, as is the time bound, I am just quickly winding up. The study is still moving on. This is the initial result we have presented, and there is any comments we are happy to take. So there is a strong co-movements and coherence among ESG investments and stock returns among most of the countries in the region, relatively less for few. So our findings show that climate uncertainty has a positive effect of ESG return. That it is not that one causes the one positive relationship we are saying. It might be what we presume is that indicating the climate risk is not adversely affecting the ESG, rather improve the return during the uncertainty. When there is an uncertainty of COVID or any other disaster, investing in ESG is trying to mitigate the climate risk, or the adaptation comes there. That might be the reason of the positive, but still we are trying to analyze it with another model to see the robustness check, whether it is the true or what is the real, because this is the first study that is showing in this kind. So that is the contribution of the study, if it's so. Our finding also shows that conventional stock return has adversely affecting the climate risk, whereas the normal stocks. So thus our overall findings suggest the ESG investment can be used as a climate risk and as a portfolio diversification strategy in East Asian context and the country of sample. So thank you so much. I'm just stop sharing, or I'll welcome the comments. Thank you.
Thank you for interesting presentation, Dr. Taghizadeh. So, do you have any question? How about? No? So, how about online audience? Do you have question? Okay. So, may I ask one question, please?
Thank you very much for your excellent presentation. And yes, you have shown a very good job, in terms of showing the positive relationship between the climate risks and ESG investment. Just I'm wondering whether you have any plan to consider the country-specific, performance, because right now we can understand that, the positive relationship between the climate change or uncertainty with the ESG investment in a panel framework. Do you have any plan to go for individual country-specific analysis in the paper? Thank you.
Yeah. Shall I reply back or take the questions, more questions? So as far as we planned, this is only preliminary. So if there is, because anyway, the coherence analysis and all, each is country specific. So, and we have only the full sample for the selected countries. So we have, if the study permits, it's under the scope, definitely we are planning to do that, because anyway, wavelet coherence and all is a country specific. So we need to do that. I guess so. And there is co-authors also. We will definitely, thank you for the comments.
Thank you. Thank you. Thank you.
Okay, thank you. Do you have any question? No? So may I ask question? Okay. You? No. Okay. So your finding shows that climate uncertainty has a positive effect of ESG return. How about COVID-19? So that factor has positive effect of ESG return. So mute, please. Please turn off mute. I can't hear you.
Yes, see, as per the ESG has a positive, again, COVID has an impact. COVID also shows the same, the positive side, because during the COVID, we use as a mitigation strategy because it's almost same, climate uncertainty, and COVID is also another disaster, like a vulnerability situation. So I think both of them showing the positive side for ESG. As per the, yeah.
Thank you so much. Okay, do you have any question? No? Okay, thank you. Interesting, attractive presentation.
Thank you.
Next presenter is Cedric Rimaud from Anthropocene Fixed Income Institute, Singapore. The presentation title is The Several Colors Greenwashing in the Sustainable Finance Market. Please ready presentation, Dr. Cedric.
Hello. Hi.
Okay.
I hope you see my presentation. So yes, the several colors of greenwashing in the sustainable finance market. So the sustainable finance market has become a very significant part of the investment opportunities for global investors. There is a very strong growth in that market, with many issuers choosing these securities to raise capital from global investors. But this market has become relatively complex with a lot of different types of instruments that create flexibility for the issuers, but also make it more difficult for investors to understand what type of outcomes they are getting when they're purchasing those public securities. So this market includes one big chunk of category, which is the green bond market, with currently, as of the end of 2022, according to the Climate Bonds Initiative, $2.2 trillion of bonds outstanding across 2,500 issuers from 85 countries in 49 different currencies. So this is already a very big market. In addition to that, there are the social bonds with $656 billion for 772 issuers. When you combine green and social projects together, you can finance it by issuing a sustainability bond, and that represents another $682 billion globally from 500 issuers. And then there is, so those three categories are historically the ones that have been more favored by investors and issuers. But now we see new categories emerging as well, like the transition bonds, which are also some use of proceeds instruments for $12 billion. And a new type of instrument that is not a use of proceeds instrument, but helps finance general corporate purposes, which is the sustainability linked bonds with $200 billion out of 336 issuers. So as you can see already, there is quite a range of different categories between green and social, and all these securities are subject to the definition of the assets that they are financing. So the investors have to now, in addition to evaluating the credit risk, also understand what is the nature of the projects that are being financed. This creates an asymmetry of information because the issuer has some flexibility on how they can define those categories.
Thank you.
And different issuers also have announced some transition strategies that are more or less ambitious. And sometimes there is confusion or uncertainty as to what the companies are trying to achieve. So the issue has arisen that the investors may be purchasing certain securities without understanding how these instruments match their own ambition of transitioning their portfolio. And greenwashing has become a new type of risk for global investors. So greenwashing is essentially misleading information that the issuer will give to the investors about how their company is transitioning to a low carbon future or selecting specific social criteria. So there are several types of greenwashing cases.
Dr. Segre, please
Hello?
do slideshow. So because font is small. Okay.
Is this better?
Thank you.
So here are some types of greenwashing cases that we have identified. So there are some issuers of green securities that have controversial exposures within their group. Like in India, the Adani Group has issued green bonds for some renewable energy projects, but at the same time, it is financing the development of new thermal coal capabilities in other parts of its consolidated group. There are some transition stories that lead to the issuance of transition bonds that do not match what, for example, other European investors would consider as a credible transition. So the official guidelines in Japan is that you can include some natural gas activities under transition framework. We have seen this case for Mitsubishi Heavy Industries or Osaka Gas, which have issued transition bonds despite these bonds financing natural gas investments, which would not be considered as eligible under a typical ESG mandate in Europe. So that would be considered a specific case as well. There are some other cases where we see some companies shifting their controversial exposure to private structures to hide them from the public markets. So that's what we could call public to private deals, where there's the sale of an asset into a private structure to avoid having to report the carbon emissions of that asset. We have seen also some entities that are public entities finance both brown activities as well as green activities. And this is not in line with what investors would expect. We have seen some issues also with pricing where some transactions are happening to try to avoid having to pay the coupon step up that the sustainability linked bonds would typically give to investors if the target is not met. In addition to that, there is the problem of the taxonomies that are appearing around the world to define the different categories of green assets. Different classifications leads to confusion. There are taxonomies that exist at the domestic level, at the regional level, or at the international levels. So that creates confusion for investors, and what could be accepted under one taxonomy may not be acceptable under another. So that, again, for an investor could be considered as a case of greenwashing. So, for example, here is one where there is a bond issued by a Russian thermal coal mining company that issued a bond in US dollars in September 2021 by three main banks. One of them had actually a loan to the company, so they issued a bond to public investors to refinance that loan. And there was an aggressive marketing of that bond just ahead of the COP26 meeting. These bonds actually went into some ESG indices and ESG ETF funds. And right after the issuance, the price of the bond collapsed for geopolitical reason as well as environmental risks as well. So that's one example. Another example is a deal where BlackRock, which is a large international institutional investor with a clear strategy to promote ESG funds, has actually financed a structure whereby Saudi Aramco from Saudi Arabia is shifting its natural gas pipelines off balance sheet into a private structure and issuing green bonds under the label of green transition. So typically this is not a deal that an ESG investor would consider as matching their framework, but because it is constructed in a certain way that shifts the exposure out of the perimeter of Saudi Aramco, they are coming to market with a green label. So that's again a case where we see problems arising for the investors. So another one is in Singapore, where the utility company Sembcorp has sold a coal asset that it held in India into a private fund held by some Middle Eastern investors, and has provided the financing for the purchaser of that asset to acquire it into the private funds. The reason why Sembcorp did that was, one, to reduce its carbon emissions, because as a result of shifting the asset outside of its reported perimeter, it's able to deconsolidate those carbon emissions. But also it had issued some sustainability-linked bonds prior to this transaction, and those public securities have a step-up coupon if the company does not achieve its carbon emission reduction. So as a result of selling that asset and putting it off balance sheet, it is able to avoid the step-up coupon under this sustainability-linked bond. So the fact that Sembcorp is providing financing to the purchaser of that asset means that essentially they retain an interest in that asset. So clearly they are doing that to basically at the detriment of the investor, who will not be receiving the coupon step up that they were promised. So that's another case that is quite problematic in this market. So in that analysis that we propose to conduct is to try to classify these different cases of greenwashing into categories and try to see what can be done to try to remedy those cases and try to ensure that the development of the sustainable finance market continues with the trust of the investors, so that it can really provide capital to the projects that are worthy and are part of the decarbonization trends that we see globally. I will stop here and then I can answer some questions. Thank you very much.
So thank you so much. Nice presentation. Do you have any question from online audience? Okay, do you have? Okay, if you
question?
Any question later, please.
Okay.
Dr. Cedric. Okay,
yeah.
Thank you. So good presentation. So next presentation is Marisa Marahayati from National Institute from Environmental Studies. So presentation title is Exploring the Determinants of Green Bond Performance in Asia, the External and Internal Factors. Dr. Marisa, please our presentation. Okay. Ready?
Yes, thank you, Prof, for the opportunity. I present for Ibu Marisa Marahayati. Let me present my presentation. Thank you for the opportunity to present our research. Our paper, which is about exploring the determinants of green bond performance in Asia, external and internal factors. Here is the outline of our presentation. Global warming, which caused climate change, has impacted the natural disaster and threatened humankind. It needs high cost to manage the damage of climate change, especially for developing countries. A necessity for government to seek more financing for climate change mitigation. The cost of addressing the damage from climate change increased to $0.6 trillion per year by 2020. Case of Indonesia, financing needs is about $281 million to achieve NDC targets in 2030, and need to double it to achieve net zero emission in 2060. Climate budget in Indonesia, in national budget, is around 5% of total financing needs, according to Marahayati and Anggraini 2023. From the graph, we can see the rapid increasing of the issuance of green bonds. In the scale of Southeast Asia, the number of participating countries also keep increasing annually. In the Southeast Asia region, the issuance of green bond experienced increasing trends. The product diversity also increased. The issuer from government, corporate, and also issued in local currency and foreign currency. Something come up from the phenomenon is the green bond. Really interesting. Is the investor really aware on the green aspect of the instrument? One of the interesting things from the green bond is greenium or green premium. From the previous research, green premium or greenium is the spread between the yield of green bonds and the yield of conventional bonds. With the existence of greenium, investors are willing to pay extra for a bond with sustainable impact. Previous research find no greenium, but another research, greenium is found in the primary market, Agliardi and Agliardi 2021, as well as in the secondary market, Alessi et al. 2021. So we can conclude for the research question, is there greenium existed in Asia's green bonds? And what is the determinant of yield spread between green and conventional bonds? From the research framework, we use CHAM to identify greenium, and to determine the determinant factors of yield spread, we use ordinary least square. The result of research will give insight to the managerial impact on green bond investment. The data we use in this research is cross-section data. The data consists of green bonds and conventional bonds issued in the period of 2016 and the end of 2022, and are still actively traded. All data collected from Refinitiv Icon. Data is collected according to issuer, ticker, ISIN code, issue date, coupon, maturity, issued amount, credit rating for each green bond and conventional bond. Sampling: 75 samples of green bond and 2,916 samples of conventional bonds were obtained. The countries in Asia that are the sample of this research are China mainland, Japan, South Korea, India, Hong Kong, Saudi Arabia, Philippines, Indonesia, and Singapore. And green bonds are issued by corporation, government, agency, and supranational institution. To identify greenium, greenium is the difference between the yield of green bonds and conventional bonds, which have the same characteristic. The process of pairing green bonds and conventional bonds, which have the same characteristic, is carried out using the Corson exact model or CHAM. The CHAM method is an effective method used in cross-sectional data, and the results obtained are more statistically robust than the use of other methods. Data processing in CHAM method is carried out using software R. In software R, the criteria used are used as an algorithm for further matching. From the selected pair sample, the spread is calculated between the yields of green bonds and conventional bonds. To determine the determinant of green bond performance, we use ordinary least square. Ordinary least square is used to analyze the determinant of green bond performance proxied by the yield spread between green bonds and conventional bonds. The model is adapted from CIMAT 2021. The internal factors variable are rating, coupon, maturity, and type of the issuer. And the external factor are oil price and interest rate. And these are the definition of the variables. The result from the processing data, the maximum greenium value found is minus 0.02, and the minimum minus 3.56, while the mean greenium value found is minus 0.68. The greenium is found in users who use their funding to build power plants, sustainable transportation, such as building high-speed trains and renewable energy sources. Greenium is found in green bonds issued in Asia, especially in Japan, South Korea. Greenium is mostly found in green bonds issued by a corporation, and the rest is issued by government and agencies. Green bond issuers in South Korea are dominated by power and energy companies and funding companies that use the proceeds from green bond issuance to fund energy projects. Proceeds green bonds are used to fund environmentally friendly transportation projects, such as those carried out by issuers from Japan and India. This finding is in line with research from Hu Zhong and Chow, Loeffler et al., and Agliardi, where green bonds are found in corporate issuers. This shows that there are non-pecuniary motives for green bond investment decisions. This can be a consideration for policymakers to make regulation to support the development of green bonds as an alternative to sustainable financing. To determine a yield spread, we run the data, and these are the summary statistics. For example, the maximum coupon found in China mainland and the minimum coupon found in Japan, and others, the max maturity found in green bond issued in Japan. From the data we have running, determinant of yield spreads are coupon, which have a significant value 0.00 or below the 0.01. And then type of issuer, oil price, and interest rate. The internal factors of yield spread. Greenium or yield spread is affected by the green bond coupon rate. The smaller the coupon value, the wider the spread. This indicates future economic growth, which means an increase in green bond investment performance. According to Fama and Friends, 1989, the yield spreads among bonds can be used to predict the rate of returns on bond. These results support Loeffler, but these results differ from CMET. And the second one of internal factors is the type of issuer. The type of issuer has significant positive effect. Corporate issuer have a great risk than the government. This is indicated by the wider spread between the two types of bonds. And external factors of yield spread are world oil price as an external factors have a negative influence on yield spread. When world oil price increase and the yield spread between green bonds and conventional bond narrows, there is a signal for investors to place their investment in green bond because this signal indicate prospect for improved performance. These results are in line with research conducted by Broadstock 2019. The same thing was found in the increase in central bank interest rates. An increasing in central bank interest rate will be a signal for improving green bond performance. From the research, we can conclude that greenium or green premium is found in green bond issued in countries in Asia. There are Japan, South Korea, China mainland, Hong Kong, India, Philippines, and Saudi Arabia. This proves that the investor taste is the basis for making investment decision. The determinant of his spread in Asia are the green bond coupon rate, the type of green bond issuers, world oil prices, and central bank interest rate. Our recommendation is investors should consider the internal factors and external factors while making the investment decision. The external factors such as an increasing of world oil prices and world interest rates are a good signal for investors to invest in green bonds, in addition to the issuer's internal factors. Support from policymakers is needed to formulate policies that support the development of green bonds, especially those issued by private parties or corporations. For example, in the form of tax incentives and green bond labeling incentives that require a large amount. And this is the end of our presentation. Thank you for the opportunity to present our research.
Thank you for your presentation. It's interesting. So I have 2 points. One is regarding the model that, so coupon rate, maturity, interest rate, these are clear, that needs to be included. But why oil price? So it needs more explanation and a theoretical background. And because in many countries, oil is not the major source of energy. Why not, for example, coal? Why not other sources of energy? So please reconsider this part, and it needs more explanation for discussing it. So this is one thing. Secondly, since the chapter, this paper is going to be considered for the chapter or for the journal paper, so it needs to be more practical rather than just an econometrics analysis. So now the only way to show that this bond is green is by, for example, green labeling. But how to monitor that whether these resources, these financial resources that collected are really allocating to green projects? This is one thing. Secondly, greenness needs to be defined. For example, a project that is 90% green, we call it green. a project which is 30% green, we call it green. That also needs to be differentiated. And these procedures, the supervision mechanism also needs to be elaborated and needs to be highlighted in this chapter, rather than just doing quantitative work and so on, because it's going to be more practical, and chapters should provide more policy-oriented recommendations. Please consider these comments. Thank you.
Thank you for the input. I will revise my paper so we can submit it to the journal as your recommendation.
Bonds, you see that in your sample
Cedric, can you hear me? Please
Yes. Yeah.
ask questions.
This is an interesting study. You mentioned that there was some literature concerning the primary market versus the secondary market. And I was wondering if in your dataset you were able to analyze differently those bonds that were showing a greenium in the primary versus the secondary. Because what we have observed is that in the primary market, there's a lot of interest by investors to purchase those green bonds. But then over time, bonds have the same credit profile as the other conventional bonds. And therefore, there is the question whether this greenium disappears over time in the secondary market, because ultimately there are some arbitrage opportunities between the vanilla bonds and the green bonds. Thank you.
Yeah, I use the secondary market data for this research, and for I will thank you for your recommendation, and I will add for my revise.
Cedric, okay. Okay.
Yeah, thank you.
So, thank you. Good presentation, Marisa and sorry, Tina.
Thank you.
Okay. So we have take a break from now. So about 10 minutes. So now next start time is 3:05. 3:05. Okay. Thank you.
pressed.
Okay, next session, please start. Please have a seat.
Today I will talking about Japan's green transformation policy challenges and ESG investment. Prime Minister Fumio Kishida advocated the policy of green transformation last year, and it started this year. Green transformation policy is called GX policy in Japan. GX stands for green transformation. The goal of GX is to achieve carbon neutral and growth. Today, in this presentation, I'd like to share with you Japan's GX policy and its problems. This is outline of today's presentation. First of all, let me explain recent trend of ESG investments. As shown in this figure, ESG investment in Japan has lagged behind other developed countries. However, it has grown rapidly in recent years. There are many studies on relationship ESG and corporate financial performance, but empirical studies on Japanese firms are limited. Professor Nemoto, she gave us a keynote speech in this session, show the positive relationship between ESG evaluation and the corporate attractiveness as employers. This result shows that ESG investment have a positive impact on the competitiveness of Japanese firms. So GX investment is expected to contribute to improving international competitiveness of Japanese companies. Right, let me explain the ESG investment or the GX policy. The total investment will reach 150 trillion yen in public and private sectors. First, the government will issue 20 trillion yen in the transition bond, which is named for transition to decarbonization. And then transition bond will attract 113 trillion yen in private investment. In this ESG investment, 60 trillion yen is invested in energy, 80 trillion yen in manufacturing, and 10 trillion yen in circular economy. The transition bond will be redeemed with revenues from future carbon pricing. We will point out this issue later. Let me explain the schedule of expenditure and redemption on the DX investments in more detail. The DX policy will run from this year until 2032. On the other hand, the transition bond will be redeemed from 2033 to 2050. The reimbursement financed by revenue from carbon pricing, emission trading, and carbon tax will be implemented from 2026 step by step. So far, I've explained the DX policy and ESG investments. Let's move on to the challenges for the GX policy from the three perspectives: finance, energy, and industry. The transition bond plays a prominent role in encouraging private ESG investment GX policy. Japan's current ESG bond market has grown in recent years. The current size is about 4.5 trillion yen last year, where the transition bond this year is about 1.6 trillion yen. It will have a large impact on Japan's ESG market. One problem is that the transition bond is closely related to green bonds, but not equal. The GX fund will be spent on not only the diffusion of renewable energy, but also the utilization of nuclear power. Accordingly, the scope of the green transition bond extends beyond the range of ESG investments. There's the risk that green investors view the transition bond as greenwashing. Next, there is a political uncertainty exists regarding the implementation of carbon pricing in the future. The ESG investments resulting from the transition bond will be issued in the next 10 years. However, it will be redeemed from 2033 to 2050 by revenue from carbon pricing. Historically, Japan introduced a carbon tax rate later than Europe, and its tax rate is relatively low. The current tax rate of Japan's carbon tax is about $3 per ton of CO2. Besides, there are no emission trading scheme in national level. Moreover, details of carbon tax and emission trading have not been decided. We cannot expect carbon pricing to be easy to implement. Next, let me move on to challenges regarding energy. The feed-in tariff introduced in 2012 had drastically increased renewable energy in Japan. Historically, Japan's renewable energy policy has been heavily biased towards solar power. The unbalanced composition of renewable energy should be changed. The widespread use of storage batteries is essential to compensate for unstable output of renewable energy. Besides, different from the previous government policy, the DX policy clearly steered the use of nuclear power plants. It is expected that nuclear power will play a certain role in energy as a bridge until renewable sources become more widely available. The government should restore confidence in nuclear power. It's a great political challenge. And for industry, the government should facilitate green R&D on green technology, and should the electrification of energy in industrial use shift from gasoline vehicles to electric vehicles, and to conversion from blast furnace to electric furnace and steel industry. Finally, let me explain the impact of GX policy on micro and macro level of Japan's economy. At micro level, ESG investment can stimulate R&D in energy conversion, structural transformation, resource reduction, together with enhancing the company's advantage and improving productivity. At the macro level, the change of the individual firm will lead to decarbonization and productivity gains in the macroeconomic as well. Let me summarize my talk. In this study, we examined the issue and impacts of green transformation policy that started this year in Japan. We examined challenges to finance, energy, and industry. Firstly, for finance, the scope of the green transition bond extends beyond the range of ESG, and their possibility it may be viewed as greenwashing. Besides, political uncertainty exists regarding implementation of carbon pricing for redemption. Secondly, regarding energy, the well-balanced promotion of renewable energy and development battery to utilize them, the government should restore confidence in nuclear power and should provide a scenario of coal-fired power fade out. sorry. これ、スライドがなくなっちゃった。And should enhance the electrification of energy in industry use. If the above issues are solved, GX policy will attract ESG investment from domestic and foreign investors. It's available at micro level. Individual company will be able to implement decarbonized management and increase their corporate value and enable Japan's economy to achieve green growth. That's all my presentation. Thank you.
Thank you for presentation, Dr. Omar. Do you have any question? Okay, please wait.
Thank you. As a reporter, as you mentioned, we find Japan very interesting, and the finance minister and the policy. What do you see as the greatest challenges to the implementation of this program, especially the research side?
Challenges. Thank you for your question. Challenges. I think problem is how to implement carbon tax and emission trading in future. They are not decided in detail. And how to use nuclear power in future. Many people don't believe safety of nuclear power plant after Fukushima accident. So the government do not promote restart and construction of nuclear power plant, but Prime Minister Kishida changed this direction.
How will they change this perception of nuclear power?
How
does the government plan to change the perception of nuclear
power?
It sounds very different.
Oh, yes. Nuclear plant, 60 years nuclear plant must be stopped, but Prime Minister Kishida changed this policy, and nuclear plant can be extended more than 60 years.
Thank you, Chris, on the answer.
Yeah, I have a comment. Thank you for insightful presentation. So yeah, very interesting to know about Japan's policy and especially the carbon tax, also the trading. Yeah, compared to ones in Europe, such as EU ETS, European type of carbon trading, which is mandatory, they put the definite cap. But while the Japan's one is still voluntary, and there are very corporate culture or nationality that makes such weak or voluntary approach rather than mandatory restrictions. So I'd like to hear your opinion. How this kind of feeling impact. Well, I think in my impression is that Japanese government are too afraid of putting restriction or hard rules in terms of environment. They're afraid of corporate, so they always put a conservative policy. But I don't know, just in this recent years, people are more conscious about it. Corporate are more eager to do more, for the environment or ESG. But I think that government is still very thinking more conservative way. So what's your opinion, how this kind of Japanese special kind of culture or the mind thinking is really affecting the policy?
I think this is political difficulty is very important. As I said, for firms, benefit first and then carbon pricing. I pointed out that this is a problem, but we think political difficulty in Japan, mandatory or severe environmental regulation is difficult. I think politically difficult, and the GX policy is made by mainly METI, Ministry of Economy and Industry. So the policy is biased towards industry rather than environment. This is my opinion.
Thank you very much.
So thank you. Question and answer. So thank you. So next presentation is Dr. Yan from Southwestern University of Finance and Economics, SUB, China. So please have a presentation. Presentation title is Can Capital Market Liberalization Improve Corporate ESG Performance? Evidence from Shanghai, Hong Kong Stock Connect. Please make a presentation, Dr.
Okay, thank you very much, Professor Hazard, for your introduction. So I think I need to adjust a little bit to share my screen. So please bear with me with 5 minutes.
Doctor, are you okay? I don't see that.
Okay, hello everyone, can you hear me? Okay, first of all, thank you so much for the conference committee for inviting us to share our work for the ESG practice in China. So this work is actually inspired by the idea that recently we could observe that this trend that for the investment decisions that has been reshaped dramatically towards the ESG criteria. So there has been this rising interest that has spread among investors and policymakers. So that we should set for long-term value and create sustainable financial system. But however, if we think about like the ESG practices for corporate firms, So maybe that this in short term, it will create them this such kind of like very large non-profitable expenditures. So this may create conflicts with maximizing the shareholder value. So therefore, that how corporates could obey this social goal in line with achieving shareholder value becomes a very important ESG-related questions nowadays in corporate finance. So if we go back to the previous literature in empirical corporate finance, we will find that those literature mainly focuses on using ESG as the explanatory variables to address how it influences firm-level outcomes. So for instance, from the positive side, that we could see that ESG could help firms to decrease their cost of capital and mitigate risk, and to some extent could also improve firms' performance. But however, on the negative side, we will see that actually for ESG activities, which may lead to a decrease in the stock return rewards, and also it will help firm lead firm to manipulate the external perception of reputation. Therefore, we could see that there is less attention that has been drawn to the factors that could drive firms voluntarily like ESG practice, right? So that's why we come up with this research question to explore the role of financial integration in improving ESG by using these natural experiments from the Shanghai Hong Kong Stock Connect program. And most importantly, in this paper, that we answer the question that from which channels these positive effects come from the financial integration on ESG are transmitted. Because of time limit, so I would just shortly summarize the literature. So in general, this paper contributes to three strands of literature. The first is that we contribute to the association between ESG and firm level outcomes. And secondly, by exploring these natural experiments of the two stock market connect program, so we contribute to the literature on the impact of financial integration on growth. Because based on previous literature, it has been documented that the financial integration leads to a lower cost of capital, and also maybe by bringing better governance, so which helps the firms in the underdeveloped financial markets that they could have substantially large improvement in their performance. And lastly, we contribute to the literature that which investigate the impact of foreign institutional investors on corporate governance. Because apparently based on this Stock Connect program, we will see that we will have more and more sophisticated institutional investors that comes to the mainland China. So this is the background about the natural experiment that we use. So Shanghai and Hong Kong Stock Connect program is regarded as a milestone in the process of Chinese capital market opening up. So compared to the only program before, this is called QFI. So I will briefly introduce this program. So before the SHKC program, this is the only program that foreign investors could actually invest it in the A shares in China's markets. And the QFI program only includes or allows specific licensed international institutional investors. Okay, so there's no retail investors before SHKC. So there are very strong reasons to believe or expect that this SHKC program will have a more pronounced impact. As we see, here are some facts. The new quota granted by these Shanghai and Hong Kong Stock Connect is 300 billion RMB, so which was 4 times greater than the total foreign investment in Shanghai exchange prior to the announcement. And in this time, the capital can enter and exit China freely, and it's purely anonymous trading, right? So here's an overview. So before this program, only 278 institutional investors with QFI license could enter the Chinese mainland markets. But now global investors can trade up to 568 eligible stocks listed in Shanghai Exchange. So here the global investors includes both institutional and retail investors. And the daily quota is up to net purchase of 13 billion RMB. All right, so who are the treated group? of this policy is adversely eligible firms, okay? So which are the stocks from time to time in the Shanghai Stock Exchange 180 indexes or Shanghai Exchange 380 indexes. And also plus the stocks that are dual listed in both markets. So here are the sample that we use. We have all the A-share listed companies in China from 2011 to 2021. And the data source is mainly from Bloomberg and two major data sources like in China. So we have SISMA and Wind. So the process for sorting is pretty standard. So we exclude firms in the financial industry and we winterize all continuous variable at 1% level. So overall, we will have 11 years non-balanced panel data, roughly 1,190 unique firms and 10,000 firm year observations. So here is the summary statistic for the main variables that we use. We use difference in difference as our main model. So we can see that here we use the ESG scores as a dependent variable. So the treated equals to 1 in firms that are eligible for this program. So 0 otherwise. So 0 indicates the control group. And we have post equals to 1 for the years that after this program was implemented. And the SHKC is the interaction term for the treated times post. Therefore, we can see that this beta 3 is our variable of interest. And also we control several firm level characteristics like size, leverage, ROA, growth, and etc., which we believe that which may affect firms' ESG performance. And of course that the fixed effects are also considered. So we add year fixed effect or industry fixed effect or firm fixed effect, okay? So this is baseline results. So we can see that compared to the control group, that the treated group have a more pronounced change in their ESG performance. Okay, and this results is quite robust after we controlling the time variant industry fixed effects. All right, and also because of the data availability that we could also be able to decompose this ESG into 3 parts. So we can see that all the parts are quite significant and all the controls are added. And those ones, so for the environment part, so this is based on the firms. So they have like several indexes to have this score. So maybe like many, namely based on firms' carbon emissions, or whether they will have green investments or sustainable investments. And for the social perspective, so this one evaluates how the firms like their employee welfare about, for example, like the gender wage gap. And from the governance perspective, so they also have several indicators like the board independency or diversity. So we give 2 mechanisms to explain our baseline results. So the first is that the positive effect on firms' ESG bringing by this financial integration is transmitted through the improvement of corporate governance. So as existing literature has highlighted the role of institutional investors in promoting governance, so we'll build up this hypothesis that firms with weaker governance ex ante will have a more pronounced improvement in their ESG. Because intuitively speaking, we will think that for firms with weaker governance ex ante, this shock, they will be like large exposed to this shock. So what we will see is that we use the foreign-owned dummy, so which indicates that firms with a foreign ownership priority to this program. And we can see that indeed, if firms have foreign ownership, so which indicates that they will have better governance before this program, so they will have smaller change in their ESG performance following this shock. And this result is robust after we controlling for the industry year fixed effects. And there's another mechanism that we highlight is that these positive effects is transmitted through the incentive of attracting lower cost of capital. So this equity opening up reduced financial constraints has been documented by a lot of literature. So in order to attract these lower cost of capital, so most of the firms are motivated to signal the market by investing in environmental and social contributions. Therefore, that in return, that these investments serve to improve their ESG performance. So therefore, that we further test the following hypothesis, which is that firms with higher cost of capital, they will have more incentive. Therefore, they will participate more in ESG practices. So here's the results. So following the previous literature, we construct two measures to measure the cost of capital. So we will see that, so compared to the high cost group, that the low cost groups, they have less incentive. So that's why we will see that the change in ESG is not significant. But for firms with high cost of capital ex-ante, they will have more incentive to improve their ESG in order to signal the market to attract more external financing. Okay, so here are some robustness checks. So first, to further address the concern that there may be different characteristics of firms across the treated and control groups, so we adapt TSM method to match each treated unit with a non-treated unit of similar characteristics. We use size, ROE, and growth. So we will see that the results are still consistent and robust. And another robustness check is that we consider the effect of the Shenzhen and Hong Kong Stock Connect, which was announced 2 years after. So we further exclude the samples after 2017. And last, we use the alternative ESG measures. So we use the ESG rating data from another database, the Sino Security Index. We will see that the results are still consistent. So here comes the conclusion. So in this paper, we find that the capital market liberalization promotes firms' ESG practice, and the effects are transmitted mainly through two mechanisms. So the first is by increasing firms' incentive of attracting a lower cost of capital. And the second is that achieving better governance with bringing in more institutional investors. And all findings are robust to several alternative specifications and the assumptions. And lastly, the contribution of this paper is that we provide a novel perspective to study the social effects of financial integration. And we document a new angle to explore the way of influencing firms' voluntary participation in ESG practices. And lastly, this is a cause for continuous opening up policy in China to promote governance. Thank you. Any questions?
Thank you for interesting presentation, Young Tan. So do you have any question from online? Any question? May I ask a basic question? So low cost capital means so low interest rate?
I think this is general, like the overall cost of capital that firms use to raise. I think these measures both equity costs and debt costs.
Okay. So do you have a question? Okay. So thank you for a nice presentation, Dr. Yang Tan. So, okay. So next presentation is Diane Latifina and Miss Kitakyushu. Sorry, I can't pronounce correctly. So from Economic Research Institute from ASEAN and East Asia. Please your presentation.
Okay, shall I start my presentation? I shall share my screen. Am I audible?
Yes.
Okay, good. One moment. Okay. Hello everyone. My name is Dian. With my colleague Chitra and Setiawati, we are going to present our study on environmental, social, and governance investment in Indonesia in the perspective of a policy framework. For today's presentation, this is our agenda. That first we are going to see the overview of ESG, and then what the strategy of ESG investment has been developed globally. Then looking inward to how Indonesia perceive these ESG trends, and end with the conclusion. First of all, the face of the business is changing, that sustainability become normalized in the activity, while buyers and investors expect to see the companies transform. There is a shift paradigm in corporate activities that from CSR perspective into ESG perspective. Then in the ESG evolution, that there's a conversation that ESG as an environmental, social, and government as a use as a measurement the non-financial impacts of particular investment and companies. And then ESG also being used and provide as a range of business and investment opportunities. In the recent days, that the World Economic Forum defined 3 new paradigm shifting. Firstly, from message to meaning, that ESG incorporates transparent and specific metrics that brings a new layer of meaning to impact storytelling. And the second is from silos to system, that ESG issues are intersectional by nature and requires a system-based approach to management. And lastly, it's from cost saving to value creation, that ESG acts as a strategic lever to deliver on a company's purposes, thereby driving growth and performance. We can see that the integrated ESG principle into business investments also has been increased in a global business and financing. There is a growing incorporation of ESG into investment analysis, corporate strategy, and decision making amid widespread social economy challenges and renewed environmental commitments. And then the trends of ESG also has been increasingly recognized as a strategy for climate risk mitigation and value creation within the corporate. With that, resulting in triggering business to consider ESG principle embedded into investment model plan and business core model. The value of integrating ESG factors also can be a buffer pertinent to climate change issue, market volatility, and long-term sustainability performance. And then also with the ESG conversation, it has been influenced by public opinion as well. As more companies provide ESG disclosure and commitments and giving speed of social media, the result is that companies who implement the ESG actions and inactions affected companies' reputation in public area. With our study, we are looking at how ESG principle being incorporated into policy framework towards sustainable investment with the case study in Indonesia. The objective of this study is to overlook the value of integrating ESG principles into business investment. And then we are also looking at how Indonesian policy framework accommodate the ESG and sustainable finance framework. with the methodology of integrative literature review, we found that there are several findings in Indonesia. First, that a sustainable financing policy has been established in Indonesia and mainly regulated by the Indonesian Financial Services Authority. Under this, we call it OJK, these new structures of sustainable finance policies, we've been developed several documents. And then those three that I presented today are the main document that mostly corporate and bank use it as a framework and a benchmark. Firstly, there we have a sustainable finance roadmap phase 2 from 2021 to 2025, and we have also a regulation to regulate the sustainable finance to financial services, as well as having a green bonds framework in Indonesia. And then these trends also producing the increase of stock markets that having a good ESG assessment. And as for now, we have like 30 stocks has been determined having a good ESG. And then also the increased number in implementation of sustainability reporting within the corporates. Looking at the ESG investment strategies, we are looking based on the Cambridge Institute for Sustainability Leadership. There are five sophisticated classification on looking at the type of investment that can be conducted. Firstly, from the conventional investment that limited or not limited, focusing on ESG factors, and then moving towards screening on the impacts and norms based on the screening. And then there are two new approaches, which are ESG integration and thematic investment, which represent slightly more active approaches to investment selection, and a strategy comprehend to even the most advanced screening method. And then lastly, the impact investment that more on the intention of generating positive, measurable, social and or environmental impact alongside financial returns. And then in this study, we're also looking at how other countries and the global perspective seeing and implement ESG in the financial services. As we know that the global initiative to encourage financial institutions to support sustainable development, promote environmental and social sustainability through the Equator Principle that has been adopted by 134 financial institutions within 38 countries. And then if we can see the picture on the right side, this will be one of our literature, our foundation to see which position of Indonesia towards ESG implementation and the leadership in the sustainable finance. As we can see that we are going to see that whether Indonesia will be in the low or in the active management, active engagement, or front runner of the ESG implementation. Okay, then from now on in this presentation, my colleague will continue to explain. Chitra,
thank you so much, Dian. So in this slide, I would like to explain on the Indonesia perspective on ESG. As we all know that Indonesian government right now has been proactively establishing the circumstances and enablers for smoothing a transition to ESG, and it according to UN SDGs. And as we can see here, the Indonesia regulation related to ESG and sustainable finance that the government use they kind of defied the regulations based on like the environment, social and government, and also ESG itself. And there are like 2 reports that just published last year on 2022 from Indonesia Financial Services and also Ministry of Finance. And back in 2009, like we call it SRI, Sustainable Responsible Investment KHATI. They publish a green index based on the ESG on the KHATI stock index. And we found like a report also from Mandiri Institute last year that the trend in increasing ESG portfolio allocation is increased in Indonesia, like driven. It is because driven from the additional new funding allocation around 39%, and also conventional portfolio to ESG related product around 33%. However, it's not applicable for the retail investor because they still consider the profit and also the product growth. Can you next? Okay, Professor Prasad. Next, okay. Here is an overview about Indonesia ESG framework. This one I mentioned before just published last 4th quarter of 2022. They have like very detailed explanation on the environment, social and government aspect. And next. So we kind of divide like the challenge on in ESG implementation in Indonesia in 5 aspects. First, there is a knowledge gap in understanding ESG necessity, issuer impacts, and how to integrate to model. And also it is relevant to a lack of the relevant expertise on ESG. And the second one, we found out that in Indonesia right now, there is a tendency of ESG label for kind of quote unquote branding. They on the sustainable in their sustainability report, and also there is also an availability of ESG monitoring and evaluator. And third one is about the challenge is about the additional cost of ESG implementation. In case of for example, there is like retail investor that right now still not interesting to implement ESG because they kind of still thinking about the profit. And the fourth one is difficulties in determining ESG related criteria, metrics, and performance indicators. And last one, the challenge we found is lack of intensive incentive in the ESG project funding and policies. Next. So for our last slide, we would like to have kind of discussion in our paper, and also our initial policy recommendation for now is we want to strengthen the capacity of relevant institution and major players in Indonesia. And the second one, strengthening the cooperation between the government and private sector is the key to successful ESG implementation. And the last one, mainstreaming the policy direction towards ESG implementation, including taxonomic criteria and standard in terms of regulatory framework and business practice. I think that's all for us. Thank you very much. Thank you, Dian. If there's any question.
Thank you for nice presentation. Do you have any question? Okay. Okay. So if you have any question later, so please send us something. Okay. So next presentation is from Malaysia. So Taghizadeh-Hesary, please have a presentation.
Okay, sure. Can you hear me?
Yes.
Can you hear me? Thank you. Okay, I'm sharing my screen now. I hope you can see my screen. Apa jadi?
So we can slide.
Macam okay.
Okay.
Okay, can you see?
We can see.
Can you? Okay. Okay. Sorry, just now I was kicked out from the Zoom. Can you see my slides and can you hear my voice?
Yes.
Okay.
Please
I will start my
do slideshow.
When I click slideshow, the system hang. Okay. Okay, how about now? Is it okay, right? Okay. Thank you very much for inviting me for the conference on ESG investment in East Asia and Southeast Asia. So today I'm going to talk about recent SDG and ESG implementation by Qatar government during the World Cup 2023 last year. So this paper was led by myself and then co-authored by my co-researchers, Professor Rizky, Professor Koyum, Professor Asmi, and Professor Musharraf. Okay, so the content for the presentation today, first I will start with the introduction and literature review, methods, findings, discussion, and also policy implication. So from morning until now, we have discussed a lot of papers on the ESG as well as Sustainable Development Goal. So we have to come to the conclusion that ESG now is not an option, is rather a need. The reason Qatar 2022 FIFA World Cup has brought attention on the Qatar ESG practices, whereby the country seek to promote sustainability and social responsibility. The Qatar National Vision 2030 for an unmistakable picture of the country future and intended to serve as a foundation national goals as well as plan of action. After a fierce, very tight competitions, Qatar beat out other contenders like USA, South Korea, Japan, and Australia to host the World Cup 2022. And they're championing in organizing such a mega event in the sports arena. When Qatar was selected to host 2022 World Cup, the country government immediately started investing heavily on infrastructural improvement and construction of FIFA standard stadium, as per Al Jazeera report 2020. The majority of Qatar estimated the budget for the organizing such a mega event is about 220 billion budget, and mainly concentrated on the public transportation, hotel construction, rather than the stadium construction. Some key differences between FIFA ESG practices before and during the FIFA 2022. The focus the Qatar government emphasized will be more on the environmental sustainability, social responsibility, as well as governance. So these are our motivation. Okay, we want to see what are the ESG together with the SDG implementations done by the Qatar government during the FIFA 2022. And then we're also looking at the another important elements when it comes to the all the 17 goals of SDG. We also want to look at how the religions, the Islamic values play the role during the organizing such a important sports event like FIFA 2022 in Qatar. And finally, we offer some lessons of policy implication to be learned from other countries, other country, what they can learn from what Qatar has implemented during the FIFA 2022. So these are the things that we want to explore in our paper. So the 2014 World Cup in Brazil was some way a repeat of South African experience. As in other developing country with high poverty, economic crisis, and tremendous corruptions, Brazil witnessed the preparation and execution of multiple sports projects for the World Cup amidst demonstration of the people and the community complaint of the use of such resources rather than leveraging them for country development. Against the environmental side of the conflict was the most overlooked, and the greenest World Cup was advertised as such missed an opportunity. While it is too soon to assess the sustainability results of Russia 2018, some reports are highlighting how the Russian organizers supported green buildings project in effort to avoid white elephant experiences like those in 1994 and 2010 World Cups in United States and South Africa, respectively. And then in 2018 Russia World Cup was an attempt to portray Russia as an ascendant power in needs of revitalizing areas such as outside of Moscow through urbanistic development, a tactic consistent execution of Sochi 2014 Winter Olympic Games, Horton and Sonder 2012. So the FIFA World Cup are more limited in terms of carbon decrease neutrality footprint of the competition and environmental implication, while the Olympic Games already demand sustainable development mechanism in Olympic Games biddings and preparation. Under this context, Qatar hoped to do tremendously significant preparation in 2022 in terms of sustainability. So comparing ESG practices of FIFA before and during FIFA 2022 required looking at how FIFA has evolved in terms of its commitment to ESG practices over the time. So we have outlined, okay, we have carried out this paper by looking at the detailed analysis of the SDGs and ESG implementation, as I mentioned earlier, during the FIFA 2022. And we have reviewed all the published and unpublished papers related to the FIFA 2022 from various sources such as academic research journal, reports, electronic database, together the information. And then we also looking at some reports published by the audit firms, and then published by the UN and etc. And then we try to summarize it, and from there we try to share some of the policy implication. So if you look at the Sustainable FIFA World Cup, the key objective is to, on my right-hand side, environmental, social, human, governance, and economic. But for this paper specifically, we just focus on environmental, social, as well as governance, ESG. Okay. So the first part of the findings, I mean, from our paper, first is we're looking at the sustainable buildings. So we can see the Qatar government did, come up with to fulfilling the SDG goals 8, 9, and 11. They come up with a container cabin accommodations. Not only that, to fulfilling the zero hunger SDG goal number 2, 8, 9, and 12, they come up with the container restaurants as well, which this one can be dismantled and can be used for the futures events as well. So this actually try to, and they want to show that how it can be carried out, can provide the facilities at the same time in an innovative way. And then if you look, another interesting part, really eye-catchy, is they also come up with the box park Qatar. Okay, this is to use for the purpose of the shops, cafe, food trucks, commercial outlet. So this has really become a eye-catchy for the tourist attention. And this indirectly achieving the target for the SDG, which is SDG goal number 8, 9, 11, and 12. Furthermore, Qatar also donate the World Cup cabins. This is really a good initiative taken by them. World Cup cabins as a disaster shelter for Turkey and Syria earthquake victims. So this is indirectly, they're not only achieving their SDG goals within the country, but at the same time is also outside of country. And this is fulfilling the SDG goals number 1, 3, 11, and 15. Continue with that sustainable buildings. The Qatar also more focus on carbon emission. So as we can see that compared to other organizers in the FIFA World Cup, South Africa 2010, Russia 2018, Brazil 2014, the Qatar 2022, the emissions, okay, for the construction part is only used close to about 50%. And then on the traveling part is about 80%. The others is shared accommodations and others. So this shows that it's really played the role. I mean, the practices really utilized by the Qatar government in controlling the carbon emission. Furthermore, the Qatar governments also invest so much on the green spaces, whereby after winning the bid, okay, Qatar has increased the amount of green space in the country. So the government of Qatar, they increased the number of parks by almost 250%, from 56 in 2010, and then during the FIFA 2022 is about 148. And they also come up with these Furjan styles of parks, whereby it incorporated the pedestrian and cycle park, seats, lighting system, tree planting, and as well as green areas. And they have increased by 16 times from 2.5 million square meters in 2010 to 43 million square meters now. Furthermore, on the public transportation, they are providing metro systems, bus network, cycling infrastructure, electric vehicle charging station, which is all are green facilities, okay? And furthermore, the facilities part, okay, they come out with the dismantle stadiums, whereby the stadiums can build on the spot and it can be dismantled after the event. And most of the items used in the construction of that stadium is actually a carbon-free items, so which is really fulfilling the target of this sustainable construction, energy efficiency, water conservation. And another interesting part is accessibility for the disability people. This is also a very good initiative taken by the Qatar government. And obviously, in the SDG goals, we have 17 goals, but Qatar government, when I look at the policies and etc., and then I think they really emphasize on the values of spirituality. So here the spirituality, I'm referring to the Islamic values, At the same, they want to safeguarding the religions, safeguarding the life, safeguarding the intellectuals, safeguarding the programming, and etc. At the same time, all these objectives also in line with the sustainable development goal, except the point number 1, safeguarding the religions. And furthermore, safeguarding the wealth. All this indirectly achieving the sustainable development goal. So the FIFA 2022 World Cup brought a lasting impact on Qatar economy reputation through increased tourism investment, enhanced global visibility. It has a positive impact on Qatar's sustainable development goal and promote ESG factors through measures of such as energy efficient infrastructure, waste reduction, and workers' rights. In addition, Qatar has demonstrated the compatibility of Islamic value and principle with international sporting events and providing opportunity to showcase hospitality, sportsmanship, unity, diversity to the world. Furthermore, it is also aligning with the principles of Islam, Maqasid al-Sharia, promoting value practices that contribute to the preservation of life, as I mentioned to you just now, the Islamic values, intellectual, religions in line with the Islamic principle. Okay, the FIFA 2022 World Cup contributed to the preservation of life by promoting healthy lifestyle, physical activity, as well as ensuring safety and security measures for the event. So the FIFA World Cup has provided a family-friendly environment, encouraging positive value behavior among participants as well as spectators. Policy implication. Government and the policy makers can prioritize sustainability in the planning and implementation of major events such as sporting event, concerts, and conference to reduce environmental impact of this event and promote SDGs. And the businesses also can adopt ethical businesses practices, promote transparency, social responsibility, fair labor practices in line with the principles and also sustainable development goal. Furthermore, the tourism hospitality sector can leverage the positive impact on the major events on the local economy and society while ensuring local communities are engaged and benefit from the events as well. And international organizations such as UN can use the FIFA 2022 World Cup as a platform to promote the sustainable development goals, encourage countries to adopt sustainable policies as well as practices. However, this is subject to the country developments as well, the economic initiative or policies taken by the government. Integrating ESG and SDG practices is crucial now because it's enable business to address pressing issues like poverty, hunger, climate change, and inequality, achieving the sustainable growth, reducing costs related to the waste and pollution. It also helps business to attract ethical investors, foster positive relationship with stakeholders, and also make the positive contribution to the creation of the more sustainable and equitable world. Okay, and the company can also become sustainable leaders and have a beneficial influence both within and outside of their operations by prioritizing ESG and SDGs. Additionally, corporation benefit from aligning business practices with ESG and SDG activity also can resolving some of the world's most urgent problems right now related to the SDGs as well as ESG. So when making a business decision, it is crucial for the top management of the corporation to take into account ESG and SDG into consideration. And this is demonstrated by the rise of the ESG report, which demonstrate how business are integrating ESG in their operation. So with that, I would like to conclude my presentation. Okay, so yeah, thank you very much. Yep, thank you. So that's all my presentation for the section. I hope I have finished within 10 minutes.
Hasanuddin, for your presentation. Nice to see you here. Yeah. So I also echo what mentioned by Dr. Troy. So your chapter and presentation is interesting. However, it's more look like a government report rather than an academic. So we need to also criticize. We need to show the reality, not just the positive part of it, but also the negative part of it, and in order to reach to a good conclusion. So during the, World Cup, especially in the construction of the stadium and so on, we hear the news that many people lost their lives. So where is this in this chapter? And also the human rights and so on. So this needs to be elaborated. This needs to be discussed in order to have a realistic analysis.
Okay. Thank you very much.
If you want to say something, we are waiting for you. If not, we go to the next presenter.
Yes. Yeah, definitely. Yes, in our paper, we have just covered on the positive sides of the Volca implementation. How do they integrate the ESG and SDG? Then I think that is a really a good point by Professor Troy as well as Professor Farhad on the negative side. So we will create a one sections on the negative sides, what happened during the organizing these mega events, and then we try to incorporate one section on that to make it the papers looks not so government reports papers, but it is both governments as well as academic reports, research papers. So we will try to incorporate, and then we will send it back to the committee members. Thank you very much. I appreciate that.
Okay. Yeah. Okay. Okay.
Thank you very much for your kind invitation. So let me start my presentation. Actually, this is a project I'm working on. So this is a joint project between my Kitakyushu University and Taif University, Saudi Arabia, Kitakyushu University, China, and Taif University, Saudi Arabia. So for right now, we have collected some data and started some analysis. So let me share some detail about the project and the expected outcomes. So ESG and the green bond issuance. ESG and green bond issuance in this project, we will focus on the bond issuance and the study whether the environmental, social, and the governance profile of firm affect the funding cost. So in the second perspective of investor activity is the investor return, the funding beyond what could be explained by the corporate fundamental and the bond characteristics. This one. Yes. Okay, so the second perspective of this investor perception, either the investor prefer the diversified portfolio in ESG for the eligible stock or the green bond. Usually we have the two options as an investor perspective. One is the debt and the second is the equity. So in terms of green bond, it's considered as a debt. So lower return, the lower the risk. The need for the studying the dynamics of the green bond market is reinforced by the fact that the growth of such debt securities in the international market has not been slowed down by the COVID-19 pandemic. And in the amount of the green bond issue gradually only in the first 6 months of 2021 reached 248.1 billion, exceeding the record-breaking figure of 2020, 269.5 billion. Green bond issues expected to further increase by 25%, about 565 billion euro in 2022, based on the European Commission pledge to issue up to 280 billion green bond under its recovery plan to 2021. So now, why ESG with a green bond rather than the stock? A new witness: green bond and the environmental, social, and the governance stock market return have reacted to the COVID-19 crisis. Unlike the Standard & Poor's 500 index, response to green bond and ESG market to pandemic proxies is the non-linear. The one significant problem to the lack of standardization and transport practices is miring, reporting the ESG score, which hinders the meaningful comparison evaluation of companies' sustainability efforts. Additionally, the prevalent issue of the greenwashing, where companies falsely portray themselves as environment friendly, and it undermined investor trust and impaired the accurate assessment of their environmental impact. Moreover, the limited availability of green bond and challenges in verifying their environmental benefits. And then it's addressing these problems are crucial to promote the transparency, ensuring the credibility of the sustainability practices, and fostering the growth of sustainable investment. So what are the project research questions? So the fundamental impact of ESG score on the yield of green bond, and how does this relationship vary across different industries and sectors? To what extent does greenwashing affect the yield of green bond? And what are the specific indicators of characteristics of greenwashing that we have most significant influence? And corporate ESG score and greenwashing concern with the market investment decision related to the green bond. That's the fundamental objective that we are miring in this what?
Not shared in Zoom.
It's okay. Okay.
Yeah. The slide not changing.
No, it's okay. And finally, how do the regulatory framework and the disclosure requirements regarding the ESG? Okay, so we have planned to use two models in this project. One is the regression analysis, the econometrics, and the operation research. We will use the regression and the family of regression model in econometrics, and we will use the goal programming, the operation research. So in the regression, we will regress the green bond yield to maturity of green bond as a dependent variable, and we have some independent variable. But in the research, in the operation research model, we will use the goal programming to achieve multiple goals. Like as an investor, we want to maximize the return, and as a borrower, we want to minimize the cost. So by this way, we have planned to adopt two econometric model, econometrics and operation research. So these are our project variable yield to maturity is a dependent variable, and these are our independent variables and control variables: return to volatility, amount issued, public entity, amount issued, ESG-based projects, maturity and risk-free interest rate. Okay, so we have some expected results that what we are expecting these projects are high ESG score are expected to be positively or negatively correlated with the yields of green bond. And then is the presence of greenwashing practices anticipated to have a positive and negative impact on the yield of green bond, as investor may become way of potential misrepresentation, lacks of genuine competent to sustainable practices, variation in the relationship between ESG score, greenwashing, and bond yields are expected across different industries and sectors, where sectors known of higher environmental impact and the regulatory security potential experiencing more pronounced efforts. Investors are likely to consider ESG score and greenwashing when making investment decisions related to the green bonds, with greater emphasis on the reliable and transparent ESG data. Companies with higher ESG scores are anticipated to demonstrate strong financial performance and sustainability outcomes, The regulatory framework and disclosure requirements related to the ESG practices in green bond are expected to influence market behavior. And then finally, conclusion. The aim of this study is to explore the key determinants of yield to public and corporate green bond beyond those conveyed to the conventional financial use of accounts for the sustainable impact. Either the investor want to invest in the equity, in the stock, or the debt as a green bond. Interestingly, our empirical analysis may indicate that the return of the green bond is not only determined by rating and volatilities as it conveyed in the standard finance theory, but it also influenced by the degree of ESG dimensions for the underlying infrastructure. And our findings may suggest that the corporate opportunities for engaging in greenwashing may exist, and their effects are tied to the issuer sectors. The finding can also be extended to the financial services, whose descriptive behavior may be more difficult by investors. And finally, we have some future research direction. Based on the study objective and findings, there are some potential future research objective: long-term impact assessment, investor behavior performance, greenwashing direction prevention, score specific analysis, and greenwashing green bond etc. Regional and jurisdictional analysis and investor risk perception to mitigate policy and regulatory framework. Thank you.
Thank you, Professor Mushi. In question of the floor.
I know you're based in China. How does this play out in China versus US? Is there a difference between in China? So as we apply this model, is it different in Chinese market versus yeah. What you're assessing, you find the difference.
Yeah, actually the basic difference, that's what I have found. The left is a trend set, and there there's a funding. Whatever they are doing, they're trying to copy that. So, so this is the practical realistic. So whatever you will do, so then they will try to follow. If you have a plan to move from the future to yeah. So that's a little bit different. That's what I know. This is the conclusion of my 8 years.
Thank you.
Thank you. Other question, right? Thank you, Professor Mushi. Next presenter is including Kashibu, Hayato Break, Igo and Umido, Abigo, Jabu from Uzbekistan. Our presentation is on looking at potential of foreign direct investments in reduce energy intensity. Could be cosmic, yeah. Oh. Oh, let's see. So we proceed next presentation. Professor Kenneth Dr. Mushi from Kyrgyzstan here. While Professor Yilmaz Kasim. Oh. Kusa, Kemel, Toku, Shebu, Igbon, Kasi, Kashimuru, or Ina Kaston here. Oh, no sure. That's not good.
Hello?
Yeah.
Hi, is it our turn? Can we start?
Yeah.
Or are we waiting for someone?
No. Yeah. I'm doing my, please about your presentation, right?
Okay, thank you. Thank you very much. Thank you very much for the opportunity to present our research project. I hope our screen is the screen.
さっきのが残っちゃってるんですか。これズームが映ってないんだ。はい。
I hope the screen is visible to everyone. If yes, then we can get started with our presentation. First of all, we would like to thank you for giving us the opportunity to present our research in this conference. Can we screen share now?
Okay.
Okay. So, is that okay now?
Okay. Please have your presentation.
All right. Thank you very much. So I would like to thank you for giving us the opportunity to present our research titled Unlocking the Potential of Foreign Direct Investment to Reduce Energy Intensity in this conference. We're from the Institute of Macroeconomic and Regional Studies in Uzbekistan. My co-authors are Dr. Hayat Berk Saidaliyev, Dr. Umid Abidkhojayev, and Professor Lu Wansong. So this is the outline of our presentation. Today we'll talk about the relationship between FDI and energy intensity in the introduction part. Then we'll look at some empirical evidence in this topic. And then we'll discuss the data and methodology used for this research, and then discuss the empirical results, then provide conclusion and policy recommendations based on the results of this research project. So developing countries often encounter trade-offs between economic development and environmental degradation, where environmental degradation is regarded as one of the key drivers of climate change around the world. So therefore, ensuring environmental sustainability is often regarded as a great challenge for developing countries, as energy intensity or growing energy intensity threatens energy security, causes environmental deterioration, and obstructs economic development in developing countries. During the last 2 decades, the rise in energy consumption, particularly the burning of fossil fuels, has been a major cause of carbon emissions and environmental degradation. In the next slide, our figure shows the change in energy consumption levels and then average FDI received by low income, lower middle income, and upper middle income countries. So as we can see, both energy consumption and foreign direct investment levels have increased during the past 20 years. So our research looks at the problem that even though the empirical evidence reveals that energy saving, the existence of energy saving effects of FDI, the literature shows that some countries have experienced soaring energy consumption due to FDI, while others have achieved energy efficiency as a result of FDI. So there is a disproportionate impact of FDI that raises questions regarding the direct impact of foreign investments on energy efficiency in developing countries. Why some countries receive FDI and see their energy consumption levels soar, while others see their energy consumption levels become efficient. Due to often this is caused due to the lack of foreign capital or large investment needs of developing countries. Therefore, these countries often ease environmental regulations to attract more FDI. So neglecting the quality of investments, which results in the transfer of energy intense and obsolete technologies. For instance, if we look at the natural countries that are rich in natural resources, most of the times or oftentimes foreign direct investment is basically concentrated on resource-oriented industries. So this results in higher energy consumption and greater environmental pollution. Therefore, the objective of this research is to examine the relationship between FDI and energy intensity, focusing on the dynamic effects of FDI on energy intensity through technological progress. Contributions of this research lie in investigating the mechanisms how FDI affects energy intensity and how this relationship changes when there is a certain level of technological progress is achieved in a country, or FDI brings in green technologies with itself. So therefore, some of the contributions would be that we created technological progress index using the data envelopment analysis, following the Malmquist productivity index. So and categorized the countries as higher income, lower middle income, and low income countries. And besides, unlike the prior studies that use the number of patents filed, our proxy captures both quality and quantity of technological progress achieved in these countries and provides more comprehensive picture. Second, this research examines the importance of host economies, technological absorptive capacities, and technology transfers from FDI in reducing energy intensity. To capture this effect, we use the interaction term between FDI and calculated the technological progress measure. Third, following Brammer, we calculate marginal effects of our interaction term. So these would be some of the contributions of this research. And empirical evidence suggests that, for instance, Liu and his co-authors found that a FDI has a positive effect on energy consumption in Belt and Road countries. Whereas Shabazz and others also found that FDI decreases energy consumption in Pakistan. So if we look at the literature, the results are diverse. There are many contradicting research in existing literature. We thought that most of these contradictions are mainly due to the type of data is used or the methodology chosen for estimations. So based on the literature review, we developed the following model structure. As we can see here, foreign direct investment, when foreign direct investment arrives into a country, there are two competing hypotheses. One is pollution heaven hypothesis, and the other is pollution halo hypothesis. Under pollution heaven hypothesis, foreign direct investment brings in obsolete and energy intensive technologies into a country, leading to higher energy intensity or higher energy consumption, and as a result, higher energy intensity. However, under the pollution halo hypothesis, we show that FDI brings in technological progress, or it causes technological progress, bringing in advanced and energy efficient machinery and equipment into developing countries, which results in lower energy consumption or energy efficiency. So we'll be testing these two hypotheses. Hypothesis one is FDI has a positive direct effect on energy intensity under the pollution heaven hypothesis. And the alternative hypothesis would be FDI has a negative indirect effect through technological progress on energy intensity under the pollution halo hypothesis. For this, we used balanced panel data from 1996 to 2019 for 97 developing countries. The dependent variable is used as energy intensity, calculated as a total energy consumption to GDP ratio. And the main variables of interest would be foreign direct investment and technological progress. Energy intensity, foreign direct investment, and technological progress are estimated by the authors in this research, and a data set was taken from world development indicators of the World Bank and national statistics departments of the countries when the data is missing. Data on trade openness, natural resources, and urbanizations are obtained also from the World Bank, where the data on oil prices are obtained from the Organization of the Petroleum Exporting Countries dataset, OPEC countries. As we mentioned that for the technological progress proxy, we used Malmquist productivity index, and based on that, we estimated the technological progress in developing countries. Technological progress refers to the advancement of technology and the development of new and improved products, processes, and methods of production. It can lead to increased productivity, efficiency, and competitiveness in different industries, and thus can have significant impact on the economy. As we've mentioned earlier, prior studies mostly use research and development investment as a proxy for technological progress, or they also often use the number of patents filed as a measure of technological progress. But this method may not accurately capture the true nature of technological progress, as technological progress includes not only technological breakthroughs such as innovation and patents, but also efficiency enhancements such as in management and institutional innovations. Therefore, following Fair, Groskopf, and Lowell, we used the DEA Malmquist method to measure technological progress in developing countries. Following graph shows the differences in technological progress among low-income countries, lower middle-income countries, and upper middle-income countries for our data, for our sample data set for 97 countries. And this table provides the variable descriptions, as we've already talked about these. Descriptive statistics for the entire data set that we have, and then categories. We have subcategorized the countries into low-income countries, lower middle-income countries, based on income levels. Following the equation is estimated, following the model structure, we estimate the following equation using GMM estimation method, which is a powerful tool to estimate dynamic models with endogenous variables, and which is based on the idea of moment conditions. In this example, since we have greater time periods than the number of panels, the GMM estimation method is the most suitable method for such data sets. To investigate the interaction between FDI and technological progress on energy intensity, we use the interaction term between the two variables and estimate the model too. We've conducted unit root tests and found that all variables are stationary at the first difference. And these are our results. I'm just going to skip all these results and go to results section. By the way, we have used as our main estimation method, we used GMM estimation method. And for robustness check, we have used Hausman-Taylor estimation method and dynamic panels estimation methods. So the results indicate that there is a positive and significant impact of FDI on energy intensity, suggesting that FDI tends to contribute to energy intensity, as in our estimations, 1% increase in FDI levels is associated with 0.14% growth in energy intensity. This finding contradicts the previous research, such as Petrovich and Labanov and other authors who found a negative or no significant association between FDI and energy intensity. Technological progress shows negative and significant effect, suggesting that technological progress can significantly contribute to energy efficiency in developing countries, as 1% increase is associated with 0.06% decrease in energy intensity levels. Then the interaction term shows strong evidence that the combined effect of FDI and technological progress has a detrimental effect on energy intensity, signifying that FDI with technological transfers can actually help reduce energy intensity. This finding shows that the importance of technology absorptive capacity of developing countries in reaping the benefits of FDI. Specifically, 1% increase in mediation effect leads to 0.2% energy intensity reduction in developing countries. This result is important as the interaction term helps to determine the extent to which the effect of FDI and energy intensity is moderated by technological progress, providing a more comprehensive understanding of the relationship between the FDI, technological progress, and energy intensity. In conclusion, we found that direct impact of FDI on energy intensity is positive, whereas the indirect effect of FDI through technological progress is negative and significant in developing countries. Based on these findings, we have developed several policy recommendations for developing countries. First of all, developing countries should ensure that FDI is directed towards activities that are energy efficient. This is especially true for natural resource abundant countries. Governments should focus on creating attractive investment environments for energy efficient sectors of the economy through different initiatives such as tax breaks, reduced tariffs, subsidies, and encourage foreign investors to prioritize energy efficiency in their daily operations. Secondly, developing countries should actively leverage the quality of FDI to reduce energy intensity. Again, this is also specific for developing countries as there is a huge demand and competition for foreign direct investment among developing countries that they often overlook the quality of FDI rather focus on the quantity of FDI. And therefore, host countries should focus on attracting and supporting FDI that is not just an increase in production, but also increase in technological progress. This can be achieved by providing incentives to foreign investors to collaborate with local businesses and develop innovative technologies that can reduce energy intensity. We also suggest that governments should take proactive steps to create more attractive environment for investors to use renewable energy and energy efficient technologies. This can be achieved by providing attractive incentives such as grants, subsidies, and tax breaks, which can reduce costs and entice investors to use renewable energy and energy efficient technologies. Further, governments can also consider providing technical assistance and training to local businesses to help them in the adoption of these technologies. Finally, incentives should be developed to encourage local businesses to collaborate with foreign investors to develop more energy efficient production processes, because it's oftentimes local businesses, they lag behind the foreign investors in terms of technological development. Therefore, promoting the active cooperation between local businesses and foreign investors is crucial for developing countries. And by implementing these strategies, the developing countries can increase the potential of foreign direct investment to reduce energy intensity. Thank you very much for your attention.
Thank you, Professor Hayat. Any question?
What were your findings for Uzbekistan?
What was that?
What was your finding for Uzbekistan?
Well, there's no specific finding for Uzbekistan since we used panel data analysis. Our findings can be generalized for developing countries.